right. Attendees. Chat. All right. Happy New Year, everyone. Can y'all hear me okay? If you look on the right side of your screen, there's like a little chat area. Typically at the end of the presentation, I'll like address some of the questions that you might put in there, so long as it's relevant to the other 500 people on this thing. Oh, Pennsylvania, Mr. Harrison, good to see you or hear from you. Hi, Trisha. Hey, David. Okay. Let's see where we're at as far as individuals. Yeah, so we still have a number of people who we're waiting to filter in. So one thing that I wanted to cover before we get going, and Savannah representing Prevent Barbara, how are you? And Scott from Illinois, I love it. All right, I won't read off every single individual in here, but one thing I wanted to just get your feedback on. Some of you have been working with us for like 10 years, and you remember when our little client events were like 10 people strong, and we were literally pulling people off the street just so they looked like there was more individuals who put a little trust in us. Nowadays, the events we do in Charleston are like 300 people, 400 people, and what we're finding is we're like running out of venues to host our group. And then maybe even worse, at the end of the night, I'm pulled in so many directions, and you'd be surprised to hear I'm kind of an introvert. I like to just kind of sit in the corner and go deep with one or two people rather than shake hands and kiss babies. And I know Mike is the same way, as well as Chris, and all of our advisors and most of our people here feel the same way. So the poll question is very simple. Which do you prefer, right? Because we do our two big events every year. We do our State of the Union, and that's usually on the Yorktown up in Myrtle Beach. We usually do that at a large hotel. And then every year we'll do Oktoberfest, where we usually rent out a brewery. So, Nikki, is it easy enough for you just to throw that poll up there as we wait for people to spill in and just see what people would prefer? It's a pretty easy question. Is which events do you prefer, larger ones or smaller ones? I'm going to start the poll. Okay, end the poll. Just click on that if you don't mind. And then secretly, if you click larger ones, we'll probably still do a larger event. But some of the people who click smaller, we'll just invite to smaller. Yeah, overwhelmingly. I kind of knew that this was going to be the response. Because some people like larger. If I like a larger, like my church, I like going to a larger church because I just kind of sneak in the back and enter through and exit through the back. And all right, yeah, overwhelmingly, people like the smaller events. So I think that's what we're going to unroll this year. We were planning our State of the Union, and I think we're going to do that. Smaller groups, dinner environment, as well as smaller referral events and things like that. But okay, y'all didn't come in here to see me do this poll, but interesting numbers there, Nikki. Let's go like this, start the presentation. All right, y'all, we do this every year, and it's kind of a beginning of a new year. We do an economic update, a market update, and then I'm going to talk about 3 transactions that you ought to strongly consider as we head into this new year with some unprecedented events that have happened in the interest rate markets and stock and bond markets. So here's our compliance slide. This keeps me in the good graces of Paige. So read every word in this so she doesn't come at me as soon as we hang up this webinar. All right, looking back, 2022, a lot of red on this screen. S&P 500 down 19.5% roughly. The NASDAQ down 33%. NASDAQ's mainly technology stocks. Probably the biggest story is what happened to bond indices. The bond aggregate, as represented by ticker AGG, down about 13%. And I usually just shine a light on some of the tickers that have me scratching my head. Amazon, the company that we can't go a week in the current household without giving a lot of our money to, is down 51%. The crypto indice, there's actually a crypto indice made up of the 200 largest cryptocurrencies, is down close to 80%. And Meta, of course, is the new name for Facebook. Facebook went all in on the metaverse and is been rewarded with a stock price that's 66% cheaper than what it was last year. If you love misery and despair, you'll love this slide. Here is a list of the ugliest of ugly. Carvana down 99%. Peloton, everyone's favorite coat hanger, is down 95%. Beyond Meat, Coinbase, I won't read all of them off, but even Tesla's down 72%. You'll notice a lot of these names you're looking at were kind of the darlings of COVID investing, right? When the Wall Street bets crowd were piling all their money into AMC, and a lot of these names, even though they're down 90%, are literally just reverting back to pre-COVID levels before everyone went crazy with some of the COVID trades. Now, I will say some of these names, I think, if you're a discount bargain bin shopper, if you're the person who goes through the DVD bin at Walmart or likes to buy stuff off of the clearance rack, there's some viable, reasonable businesses here that are selling 80, 90% cheaper than what they were a couple years ago. And some people would say, well, Adam, these are really risky stocks. I might, refute that and say, well, they were a heck of a lot riskier a year ago when they were 90% more expensive. A lot of the risk has been cooked out of them. This webinar is not about rolling the dice and being a riverboat gambler, but it's worth noting some of these names that are down just .com bubble type percentages. So this has been the most head scratching and probably the most interesting thing about what happened in 2022. And that is retirees used to be somewhat immune to major market pullbacks because bonds and stocks kind of have a contrarian relationship. When the stock market's down, typically bonds will pop up a little bit. They'll be looked at as a flight to safety, or at least hold their own. Like I showed in that early slide, bond aggregates down 13%, the S&P 500 down 19%. So the prototypical retiree's portfolio, there's something called the 60-40 mix, 60% equities, 40% stocks. The 60-40 model in 2022, it was the worst in 90 years. We had the worst stock market for retirees since the Great Depression and the crash that came in 1937. I mean, even 2008, if you had a 60-40 blend, the financial crisis, when the market was down 40%, if you had a 60-40 blend, you were able to only lose about 14%. So last year was one of the most challenging stock markets for retirees historically. And I know sometimes we like to, it's been really hard this year compared to 2001 or something. We're going back to 1931. This is one of the worst markets we had for retiree investors in over the last 90 years. So what does the future hold? I'll give this a crack, but before I give this a crack, let me preface some of my predictions with the following hot take. This is from Peter Maluk from Creative Planning. He said at the end of 2021, they had 12 different analysts forecast where they thought the S&P 500 was headed. And these are buttoned up analysts with tons of resources and some of the best data at their fingerprints. And they minced that data and they dissected every single forward-looking trend and leading and lagging indicator. And the consensus of those 12 individuals missed the S&P 500 by 25%. And we're not talking about like a 25% discount on, an oil change. 25 percentage points on your portfolio was the consensus miss. The person who predicted the lowest S&P forecast was off by 15. So that tells us they were wagering that the S&P would drop about 5%. It dropped about 20. And then the individual who was the most bullish and had the highest S&P forecast was off by 40%. The moral of the story, short-term stock market predictions are worthless. So when individuals work with us, when we look at your portfolio, one of the things that we say around here is, I'm not betting I'm going to be right. I'm just betting I'm not going to be wrong. Individuals who work with us don't have decades to go back and earn it again. So I want you to look at your portfolio through this lens. Lord knows there are many a stock market maven on Talking Head TV right now that would love to give you a hot take on where they think Tesla stock is going, or if they think growth stocks are going to have a better year than value stocks. Put together a portfolio of instruments that zig when the market zags. Bet not that you're going to be right every single year. Just make sure, regardless of what God or the economy throws at you, you're going to have components of your portfolio that'll answer the call. And that's what we do around here. But what do we know for certain? What do we know heading into 2023? One, people are losing their jobs. Amazon's cutting 18,000 people. That's only about 7% of their workforce. In fact, when Elon Musk read that, he goes, only 18,000. He thought that they would be cutting more, like 10 to 15% of their workforce, kind of like what Twitter did. He came into Twitter and literally cut half of the workforce. Wells Fargo's lending divisions, mortgage originations are down 90%. So people refinancing their mortgages and taking out new mortgages to buy real estate, down 90%. Elon Musk came out and said that they anticipate a global recession lasting into the spring of 2024. He said the stock market environment will be reminiscent of the financial crisis. Just yesterday, the World Bank came out and said, hey, we think there's going to be a recession. I think we're already in a recession. I don't know why there are analysts and economists out there saying, basically change the rules mid-game. We had 2 quarters of negative GDP. I think we're in the first or second inning of a recession, and I think it's going to get a lot worse, and that's what most people believe as well. Now, the economy and the stock market are sometimes divorced. Oddly enough, you might get a really ugly economic reading, and the stock market applauds it, and the reason they applaud it is because they go, good, Jerome Powell will stop raising interest rates, and that'll be a good thing for the stock market. But certainly, we've got a bunch of really nasty economic headwinds, and I think there's more to come. Here's why I think it's going to get a lot worse before it gets better. The real estate industry, which accounts for close to 20% of America's GDP, has not yet even digested a little bit of what's happened with interest rates. I pulled this slide from something we did in the end of last year, and we basically said 1 year ago, people were buying homes with 30-year fixed mortgages south of 3%. And a $500,000 home with a 2.5% 30-year fixed mortgage, a monthly mortgage liability, and this is not factoring in taxes and insurance, which are also up, by the way, is only about $1,976. Then we ran it at a 6% 30-year fixed mortgage rate, which if anyone's shopping for mortgages right now, you're not getting a 6% rate. You're probably going to get national average about 6.5%. Some banks are pushing 7%. And that 6.5%, lenders are celebrating because it's come down because we seem to be trending over 7% for a while. So at a 6% 30-year fixed mortgage rate, that same $500,000 house is going to cost you close to $3,000 a month, an extra $1,000 a month. In fact, if you wanted your monthly housing allowance or your monthly housing expenditure to mirror the $1,976 at current mortgage rates, that home is now worth $300,000. That's a 40% drop in real estate prices. There are some areas in South Carolina and throughout the country, if we had a 40% drop in real estate prices, we would simply be back to where we were in the beginning of 2020. Now, I'm not anticipating we drop 40%, but what I am telling you is the real estate industry represents a massive component of GDP. Just think of a attorney that does closings. Talk to someone who's in that line of work and ask them how their business has been. I was just talking to a buddy of mine, and they were doing 200 closings a week, and now they're down to like 10. So activity has fallen off the cliff. And I know I love my real estate agent friends. You're some of my favorite people to talk to because you're always so optimistic about the economy. But we're starting to see the real estate market soften. We're starting to see homes listed for multiple months on end. We're starting to see it turn into a little bit more of a buyer's market. And I get in certain areas, in Charleston in particular, there's lots of people who want a taste of the low country, so there's a lot of sellers coming in. But nationally, I think this trend of the real estate borrowing costs more than doubling is going to have to be digested by the real estate market. And like it or not, people make their discretionary buying decisions based on the value of their house. And most people, when doing their budgeting, people on this webinar have hundreds of thousands of dollars, millions of dollars. Most of middle America makes their investment decisions and buying decisions based on what they can afford on a month-by-month basis. Go to a car lot and talk to someone who sells cars. Sometimes people will decide to buy or not buy based off of a car loan being an extra 10 or 50 bucks a month. So when you look at homes now costing an extra $1,000 a month, and you're a W-2 wage earner who doesn't have hundreds of thousands, millions of dollars, naturally, this is going to have a major impact on our economy this year. And I don't even think we've scratched the surface of what this is going to mean to housing prices. So something to keep your eye on. If you're in the market to buy a house, I would tell you to proceed cautiously. And if you have the ability to drag your feet, do that. If you have a secondary home that you never use, say the beach house, and I will say if you have a beach house, it might make sense just to put it in the rental pool for a while for all this stuff to calm down. But if you have a piece of real estate you've been meaning to get rid of, might not be a bad time to look at getting rid of that now before it turns into a full-fledged seller's market. I did a webinar on what to do in a rising interest rate environment. It's on YouTube. We talk about the things you should buy, the things you should sell, and most of our portfolios have accounted for that. All right, so I've been quoting this in most all of my visits. There's two things I read every year. Warren Buffett's white paper, which is just chock full of all of those wonderful folksy Warren Buffett quotes. When the tide goes out, we see who's swimming naked, and just mandatory reading. If you've got any kids or grandkids that are into investing, make them read the white paper every year. It'll give you a whole new appreciation for the genius as is Warren Buffett. But the other thing that I read, which is far shorter in nature, is Vanguard's Market Perspectives piece. And they release this every March, so this one's darn near a year old. They'll be doing another one in a couple months. And they basically said, hey, because the Federal Reserve is going to have to continue to raise interest rates, because there's going to continuously be new variants of COVID, which I know, gag me, no one wants to hear about that, but they were literally locking people in their apartment complexes and welding the door shut in China not but 2 months ago. So it doesn't matter how your neighbor reacts to it. It matters how the rest of the world reacts to it as well. And it seems like they've got this zero COVID policy out in the East that they're not afraid to use. So because there's going to be various COVID variants, and because they see inflation lingering, now they saw it peaking in the middle of 2022, which has proven to be pretty prophetic because it has softened a little bit, but it's still 7% or pushing 7%. They anticipate 10-year annualized rates of return on the stock market, U.S. equities, only to be 2 to 4% per year. Now, some of you might be saying, well, this is awfully bearish. This is doom and gloom stuff. Charles Schwab echoed this. JP Morgan echoed this. And I believe Fidelity echoed it. So some of the largest asset managers on the face of the earth are all saying the same exact thing. And that is, don't anticipate the rates of return that you've grown accustomed to in the stock market the last 10, 20 years heading into the next 10 years. And I hate to be the bearer of bad news because my business surrounds the stock market, but I put a lot of weight in this prediction, and I put a lot of believability in this prediction because Vanguard is a perennial bull of the stock market. Vanguard's business model is put all your money in low-cost index funds, hang on for dear life. The stock market always goes up. And they're out here saying, hey, we're going to have one of the most challenging stock markets in the next 10 years. So just know we're looking at our portfolios, the people we get to help, with this in mind when we make some of the recommendations that we're putting in front of you. So what do? What are those recommendations? What are the 3 money moves you might strongly consider making as we head into 2023, which obviously you've come to see is going to be a very challenging environment? Number 1, refinance. Now, we all know about refinancing our mortgages, right? And when we refinance our mortgages, we do that when interest rates go down. And when we refinance a mortgage, we'll typically have to pay like an appraisal cost and loan origination fees and loan doc fees. And we pay those fees because the grass is greener on the other side. And we do an analysis of, okay, it's going to cost me $5,000 to refinance, but I'm going to make that money back in 1.5 years, or I'm going to make that money back in 6 months. Well, I would tell you right now, and you're going to see in a second, I'm going to shine a light on the Fed funds rate. Right now is a tremendously opportunistic time to refinance money that's sitting in cash or money markets. We've got a money market in-house. I think it's paying 3.75%. Now, that's based off of a certain dollar amount. Fixed instruments, CDs, fixed annuities. We're meeting with individuals who bought a CD not but a year ago, and we're going, hey, that thing's only yielding 3%. Let's cut bait, get out of it. CDs are only going to cost usually like a 6-month clawback in interest or maybe a 1-year clawback in interest, and get you in something that might pay 5.5%. Linked accounts, these are accounts, many of you have these, where if the market goes up, you participate in a portion of the market's upside. If the market goes down, you'll stay flat. When we were positioning money into those accounts over the last literally 10, 20 years, the caps and the growth rates on those were only going to give us 4, 5, 6% per year. We're now seeing caps 13%, even higher in some cases, with the potential to make even higher. So even if you position money into a linked account a couple of years ago or even a year ago, it's worth having a conversation where we discuss refinancing that account into a better position. No different than how you would refinance your mortgage. There could be a surrender charge. There could be a clawback of interest that you might make. There could just be a time commitment sitting down and geeking it out with one of our advisors. But it's worth your while looking to refinance these types of instruments. I also think it is prudent right now. Flight to safety. The last webinar we did, I said, don't do anything too herky-jerky. Don't go all in one direction. I don't think that's wise financial planning. That's market timing. But it makes sense to me, and one of the overwhelming conversations that I'm having with people is, hey, right now 30 to 40% of your portfolio is in stuff that's principal protected and secure and comfort food and enables you to sleep at night. Why don't we shift another 10 to 20%? That's not taking all of your money out of the stock market that's down 20% and putting it in something that's going to give you a 5% rate of return. It's just tweaking, making a thoughtful adjustment. And if I wet my finger and stick it in the air right now, I don't think it's a bad idea to make an additional flight to safety, take 10%, 20% of your portfolio, put it in something. Because here's the thing. Had I made this recommendation a year ago, you'd be taking 10, 20% of your portfolio and putting it in something that only makes 3% per year. Now that we're making this recommendation, you're making 5% per year or potentially 6 or 7% per year. So it's a much easier move to digest when you're shifting your money into something that's actually going to make a pretty darn good rate of return historically when we look at capital markets compared to putting it basically under the mattress with a little more interest. I'll tell this story. I've got, and perhaps she's on the call with us right now, so I'll try to be private with her information. But one of my oldest clients, not old age-wise, but old time working together. This lady put a little trust in me when it was like me and my Dodge Challenger. Not much to trust at that season of my career, but she has been on her money. Like, she's the type of person who, keeps track of IPOs, regularly making adjustments between stocks and bonds, shifting from growth stocks into value stocks, taking a good hard look at Europe right now because she thinks it might be on sale. So this is a lady who's on her money, watches CNBC, Fox Business, tracks the capital markets. We were looking at current interest rates. And not that she threw in the towel, but she said, my gosh, Adam, when I look at my historical rate of return of my portfolio, and this is way back, right? She was averaging a little over 6% per year, right? And wheeling and dealing and jumping in and out of the market. and losing sleep about a bad trade. And even when she made a good trade, she was kind of, ticked off because she wished she put more into it, kind of the gambler's remorse. Well, she turned around and put the lion's share of her money in a 5-year fixed account that is structured so the interest on that account pays out on a month-by-month basis. The rule of thumb with retirement income and distributions from portfolios, the rule of 4%. They say you should only take 4% out of your portfolio, and you have a 99% probability you'll never outlive your assets. Well, she's making 5+% now. Her principal is protected, and she has more money hitting her on the head every month than she can possibly fathom spending. So now that's causing her to be more charitable. That's causing her to, splurge a little bit more foolhardily and go on that trip and fly first class rather than, sit with your knees next to your head and coach. And the final thing she said to me, she goes, Adam, well, now that I've done this, I guess I don't need to call you once a month. And my response was, I guess not, but I kind of feel like you're like a family member at this point. So will you please check in on me? I'll probably have another kid by next year. So you can kind of turn your back on the financial industry. You can turn your back on the bean counters by positioning money in principal protected, predictable things that are now yielding 5+%. Linked accounts that now offer the potential to earn caps better than what the stock market has returned historically. So look to refinance. If you work with us, you are going to hear this conversation often. Our advisors have all been, one company, one voice. We're going to be coming out and going, guys, this is what we think is a thoughtful decision for a retiree in this interest rate environment. And again, thoughtful adjustments. We're not going to take all of your money out of the stock market and put it in a fixed instrument, because what happens if we have runaway inflation for 2-3 more years? But what we're staring at right now, I think it makes a ton of sense to fly to safety with a higher percentage, refinance already accounts that are in safe places, get better yields. And some of you might just throw in the towel and go, yeah, I want to go to your client events, but I don't think I really want to continue to stare at my statements every month or log in online. You can finally get reasonable rates of return in a risk-free way. Here's the Fed funds rate. I was just at a conference a couple weeks ago. I've been in the industry now, close to 20 years. I was talking to some people who were even longer in the tooth than me. And, this is what the Fed funds rate, this is going back to 2010. Literally, you could see this blip here at the end of 2018, only got to about 2.5%. We're now at about 4.5%. So literally 100% more, or not 100%, but 70% more than where we were back in 2018. And for the longest period of time, we were at near zero on the Fed funds rate. So some of the individuals I was talking to at the conference are saying, I am seeing some of the best rates, the best fixed instruments that I've seen over the course of my 30-year career. Something to consider. Dividend investing. My gosh, we've been talking about dividend investing for 2 years now, but I'm going to say it again because I believe dividends are the lifeblood of a good retiree's portfolio. Some of you might be going, Adam, I'm a contrarian. You just showed me all those doom and gloom slides. That's typically a good time to bet the farm and put money in the stock market. Well, my plea to you would be, if you're going to put money in the stock market right now, at least get a dividend, a consistent, stable dividend that you can lean into if the market takes another step down and it drops another 20%. So what you're looking at here is a chart of a dividend stock, and you can see it's looking at an EKG, right? You'll have months where your stock is down 10% or down 11 or down even 21%. That was in the heart of COVID. But if you fix your eye more on the quarterly dividend that this stock pays and less on the paper gains and paper losses that you'll look at when you look at your statement, I find dividend stocks can be a place people who are a little more risk adverse, but like the market, but like some level of consistency. Dividend stocks have performed relatively well this past year. You'll see in a second. Our model, our dividend driver model, pays a yield of 5.48%. So if you put $100,000 in it, you're going to get $5,400 of dividends. And if the stock market drops another 20%, well, your portfolio might be $80,000, but you'll continue to get that $5,400 in dividends so long as every single company inside of the portfolio doesn't lower their dividend rate, which I find highly unlikely because when you look at our dividend driver model, it's literally spread across hundreds and hundreds of different companies. And we even have I bonds and tips and international dividends and preferred stocks and high yield bonds, a number of different income bearing, interest bearing, and dividend producing investments. So you're spreading your risk across so many different things. And if you look at this chart here, maybe one of the only places to hide this past year have been fixed investments, linked investments, and dividend stocks. Growth stocks have been slaughtered. Bonds have been hammered. The overall S&P 500 is down 20%. So dividend stocks have really been one of the only places you can preserve principal here in the last in 2022. And then finally, here again, I've done entire webinars on this. Consider funding a qualified healthcare rider. The reason I'm so bullish on these accounts right now is because when you look at the anticipated increased cost of healthcare, it's running around 3-4%, right? So if right now the average cost of care in this state or country is somewhere between $6,000 and $7,000 a month, if you're 65 years old, by the time you're age 80, that's going to be like $13,000 a month. So a lot of times when people buy long-term care insurance, which is something that we're not a fan of because there used to be 50 carriers, now there's like 4, they fight with you, they make it impossible to utilize the insurance, they reserve the right to raise your cost, just chock full of inefficiencies in my opinion. The opposite side of the spectrum, if you don't get long-term care insurance, you basically roll the dice, cross your fingers, and you agree to self-insure. And with many people who have millions of dollars, hundreds of thousands of dollars, self-insuring is a viable solution. To play devil's advocate, if you have $1 million, you also have $100,000 to position into an account that puts the long-term care conundrum to rest. So if you're having dinner with your kids and they start poking and prying, going, "Mom, what happens if you lose your marbles? Are you going to be okay?" Your kids are already trying to put you in a home. Hopefully you don't have kids like that. But look, I think your kids want to see you age with dignity. And I don't think anyone on this call wants to see their kids having to get them up out of bed and walking them to the potty. So you can put this conundrum to rest and lock in interest rates like I shined a light on earlier that are potentially higher than the increase that has historically happened with the cost of care. You follow that? There's almost an arbitrage, in my opinion, where we can get a qualified healthcare rider in this environment and pay for your future care needs at a lower cost potentially if your account performs in a way that supersedes that of what the cost of care is. Gosh, I just threw a lot of weird words out there. The bottom line is this: when you use a qualified healthcare rider, one of 3 things happens to all of us in life. 1, you might just die in a recliner after a big meal, like we all hope. Hopefully, and that's in our 80s, not in our 40s, like I've seen some of people who are close to me happen recently, and we won't go into that. But when in our 80s, we meet our maker. Any money left in the account goes to your heirs plus interest, or goes to your surviving spouse plus interest. If you put money in one of these accounts, and you go, "Hey, I can now buy real estate for pennies on the dollar, and my dream was always to own a beach house." Or I'm going to go live in Costa Rica and get treated like a king or a queen for 1/3 of the cost. You can always take your money and run. Now, there might be an early withdrawal penalty. There might be a clawback charge or something, but you have an out. You can take your money and run. Just like when you sell a piece of real estate, you're going to pay a commission for the buyer or the seller, right? You're going to pay a fee, but you get your house, get the money from the sale of your house and go someplace else and do something bigger and better with it. Lastly, If you can't do 2 of your 6 activities of daily living, a feature of the account will kick in and it'll help pay the costs of long-term care. Now, of course, Medicare, depending on what type of service, will cover you for about 90 to 180 days. Anything beyond that falls on your shoulders. And long-term care is the number 1 cause of bankruptcy in this country. This is something I think is a perfect time to put to rest, right? So maybe it's a spouse who dealt with the cognitive decline of one of your in-laws. You better believe that is heavy on their heart. And you can put that to rest to a certain degree so you don't have to think about it by funding what we call a qualified healthcare rider. Something to look into. So those are the 3 moves. Refinance fixed accounts. Consider making a slightly higher flight to safety. No longer talk to a financial advisor ever again. Use dividend stocks and consider funding a qualified healthcare rider. Let me just give you some news around our office, whether you work with us or you don't work with us. This is just some stuff that you might want to be aware of. This is just a few of us. We do our little annual fishing trip every year. And we had a little success, but there's still fish in the Charleston Harbor, so don't worry about that. But here's a few of us on that trip. You're invited. As many of you know, we had some exciting news this past year in that we launched a fund. I won't go into the details for compliance reasons, but for that, we get to ring the bell on the New York Stock Exchange. And some of you know my story. My parents took me to the New York Stock Exchange when I was 8 years old. And from that moment on, I knew I wanted to be in the money business. I knew nothing about stocks or bonds, but I was just intoxicated by the energy of that place. And from that moment on, I literally started peeling open newspapers and reading the business section like a little weird Michael J. Fox character in Family Ties, but inspired me. Now you can't tour the New York Stock Exchange any longer. So since 9/11, they don't let people on the floor unless you're invited. So we should be getting our bell date here in the near future, probably within the next 30 days, my guess. And we're going to just throw a hootenanny on the New York Stock Exchange trading floor, and I want to invite every single person who is of interest in attending. Now, let me be clear. I'm not paying to fly you up there or put you up in a hotel, but we will be throwing a party on the New York Stock Exchange after me and 13 of my closest friends and people who mean a lot in my life get to ring the bell. So only 14 people are allowed up on that little podium that you're looking at. And those spots are already spoken for. There are some people who gave me a pound of their flesh, and heck, even my mom and my dad are going to be up there. So, and of course, my wife and my boys and all the people here in the office who make the wheels go round. So, you won't be on the podium, but you're invited, and we're going to have a catered meal and some drinks and celebrate up in New York. If you're interested in attending, I might just say, hey, if you've got children in your life, grandkids, children, maybe they're in college studying finance. It's a really special opportunity that I want to extend an invite to you. And maybe they have that same aha moment that I had, where they get intoxicated by capital markets and they determine at that point in time that that's the business and that's the career field that they want to pursue. So if they're into trading cryptocurrency or they like looking at a stock on Robinhood, and we'll keep you in mind. We'll be sending out an invitation to anyone who wants to make the journey up to New York and celebrate with my team and my family as we ring the bell on the New York Stock Exchange. Okay, this one, let's try to get through this without shedding a tear or two. So when we started our firm, it was to just stay afloat, stay alive. Literally, I put my resume in at a restaurant to bartend at night, and then we got a little bit bigger, and we still yet tried to stay alive and buy a little more office space and get a couple more team members to help us out. To now, I sit back and I reflect and I look back on those days, and they were special, but gosh, they were hard, and they've probably taken years off of my life. And now I've had the absolute joy to work side by side. Those two people that you see on the screen, that's Paige. Many of you, she kind of runs the operations here and also compliance, but more so operations, and has really become my right-hand woman. And of course, that's Mike. Mike's been an advisor with us when there was 3 people in our office. Met Mike and his wife at Dave Ramsey Financial Peace University when we just got married. And my new objective, my new goal, and some of you who've been working with me for a while might have been, we've leaned on other advisors to conduct some of the reviews. And I know sometimes people will say, "Hey, Adam, I hired you when it was you and that 3-in-1 winter printer in the Dodge Challenger." And please know I'm always here, right? I have no hobbies. I have nothing. Claire can't quit making kids, and I know I have a little bit to do with that. But I'm always here. I'm at your beckoning, as is Mike, as is Paige, as is Chris. All these other guys who work with us are always here. But the goal with the company is to build a company that lasts 100 years. And I realize in order to do that, I'm going to need a lot of help, because I don't think I'm going to be here 100 years for one. But we're changing kind of the structure of the company. None of this is on paper, but it's just something that I've been mulling around in my head. And the name of our company is Current Financial Partners because the goal from day one was to take on partners of the business, right? And these two people on the screen have probably played a more integral part in the growth of the business than anyone else who walks in our office. That's not to say everyone else in our office hasn't been just absolutely, a blessing to work side by side with. But these were some of the first people in the room when it wasn't much of a company back then. So my utopian dream with the business is to have a third of it owned by me and my family, a third of it owned by the employees, and a third of it owned by a charitable trust. And with the growth of the company, individuals like Paige and Mike and myself, our roles change, right? Our roles change from the person with the shovel, digging ditches, and no doubt I'll never put my shovel down. I'll always be in my left hand. But we need to groom and mentor future leaders, future professionals. When we started this year out, usually we set a goal at the beginning of the year of like how many new families we're going to help. This year was a little unique. Our goal this year is to simply keep every single person in our office. We had some turnover this year, and quite frankly, when I reflect back on it, it was good turnover. Some of these people were in needed different companies to work with. But this year, the group of people that we have working on your behalf are just incredible. We've got a wonderful culture inside of our office. And it's my responsibility now to kind of release the reins, let some other individuals help me run this place, and also release, the profits from the place as well. People give me a pound of flesh. They deserve to be compensated for that. So that's one of my objectives going forward. And with that in mind, we have intentions on expanding up to Greenville and Columbia. This happened kind of in a unique way. One of our advisors, her husband is a airline pilot and needed to be closer to Charlotte so he can be a part of his 3-year-old's life. Otherwise, he'd have to stay in like a standby house. So they're going to be opening up the Greenville and Columbia market. So we're going to be recording our radio up there and doing all the things that we do to meet new people in new areas and new markets. So if you have any friends or family or relatives up in those areas and they're looking for a competent, capable advisor, I think we represent that, and we'd love for you to make an introduction to us or any help you can give us too. I think we're still looking for some office space in both of those places. So if you know anyone with some Class A office space, we'd love to hear what you have to say. But really exciting stuff. We will essentially have South Carolina cornered. So, boy, we've come a long way from working out of the cafeteria at the Earth Fair and in the Windermere Shopping Center to now being in Myrtle Beach, Charleston, Bluffton, Hilton Head, and Greenville, Columbia. I think one of the biggest narratives that we're gearing up to be well positioned for is Trump's tax reform sunsets at the end of next year. I don't know what the federal deficit is now, 33 trillion, I think. I might be off by $1 trillion or $2 trillion. But I think when Trump's tax reform sunsets, I think the crosshairs of the IRS are going to be on baby boomers. They're going to be on retirees because you can't get blood from a stone. And y'all have I think something to the tune of $10 trillion of wealth locked up into your 401ks and your IRAs. So naturally, that's going to be one of the main resources used to pay down the deficit if we ever feel fit to do that. Now, last year, one of my goals was to actually bring tax planning and tax preparation in-house, and I was courting a good friend of mine, and that just didn't materialize because of family stuff. On his wife had lost her father, and I won't go into all this stuff. But anyways, that didn't materialize. And we have had that job posting out for close to a year now. And we've seen some resumes, we've seen some candidates. And I just want to let you know, this is a position that I don't take lightly. When people start sinking their teeth into your tax returns, I can't have them getting up and leaving a year later. My ideal working environment with someone or working time frame is forever. I want people who have no hobbies like me and are glued to the Charleston area with kids and dogs and don't want to leave. So we continue to search for someone to help with the tax preparation. But I'm not going to put someone in front of you unless they're vetted. I'm not going to put someone in front of you unless they are a cultural fit for our company. And a cultural fit for our company means they hate the IRS and they're going to do everything within their power to legally show you ways to avoid taxation. But what you're going to see, I think, is we're going to start having really pointed visits with you. I think of someone like Colin in-house, really, really sharp from a tax standpoint, and he can sit with you and geek out using all of our tax software. Heck, we've got the same software that a lot of CPAs use to do tax planning with, and have strategic visits specifically on tax optimization. Now, not only now under Trump's tax reform, but what we might see coming forward when Trump's tax reform sunsets. The other big thing that I see happening is as our clients get older, many of them are selling their businesses. Some of them are selling those highly appreciated pieces of real estate. And we also see people becoming more charitably inclined. I want you to know that we now have resources that we had resources before, but we doubled down on those resources to help you make thoughtful decisions. So if you're a small business owner thinking long and hard about selling your business, you're going to give a substantial chunk of that business to the IRS, to the business broker, if everything goes smoothly. So I think it's John Maynard Keynes that said the only intellectual pursuit worth pursuing is the avoidance of taxes. Be thoughtful on how you have that liquidity event. It might mean hundreds of thousands of dollars in your pocket that would have been given to the IRS, which is an acronym for I rob seniors. Same with highly appreciated real estate. You can do installment sales and structured sales that can help you avoid paying tens of thousands, hundreds of thousands of dollars that Lord knows I'd rather see in your family's pocket than in the coffers of the IRS. Same thing goes with estate maximization. This is something that I think Colin's going to be having conversations with a number of you individuals on. And that is, hey, we tried to get you to spend your money. We twisted your arm. We warned you that you were going to be the wealthiest person in the cemetery. And because you have frugality in your DNA, you're not going to spend the money. So we might as well carve out a chunk of this money and just make sure your estate passes on to your heirs in a more tax efficient way. We make sure your estate goes to your heirs tax-free in many cases. So I can totally see the estate tax, which was like $2 million before Obama jumped it up and then Trump bumped it up again. So if your estate's over $2 million, husband and wife, the government used to take 50% of anything that went over $2 million. And that's including the equity that you have in your home. So for individuals that fall in those brackets, I think it makes sense to start, being proactive and knowing that the rules are going to be changing in short order and they're going to be a heck of a lot more egregious to people like yourselves. And then finally, healthcare. Some people don't even know we can provide Medicare Advantage, Medicare supplemental coverage And that's something that we're going to double down on. We've got some young advisors in our office that we're gonna have really shining a light on that. That's something that we can save you some money on. And we even have some clients that do that. We've leaned into in the past. So we want to be a full service advisor. When you come to us, there isn't anything we can't address with you, whether it be a tax issue, a healthcare issue, an estate planning issue, a wealth transfer issue, and of course, our bread and butter, investments and income planning. But we want, when you lean into our office, if it's a question that's above our pay grade, we will at least be able to shed and shine some light on the things you need to be conscious of. But ideally, we don't want there to be any issues that are above our pay grade. And that's what we're going to continue driving year after year. And that's really become my job, to keep the promise of this firm that we made to you early on in our life cycle, right? We're going to be here for you, not only to and through retirement, but when it comes time for you to meet your maker, we're going to be here for your children and make sure that this money passes on to your kids in the most tax efficient way. And if, gosh forbid, husband or wife meets their maker or loses their marbles, we'll be here for them as well. So with that, I thank you. I thank you for putting a little trust in me and my little American dream, and in the individuals who took the ultimate risk and sacrifice in working, not the ultimate sacrifice, but they took a major risk in working with me. Lord knows they could have been employed by many more name brand shops, but they chose to give me a pound of their flesh and work side by side with me, and I'll never forget that. Also with that, here's Mike's twins. Michael Bear and I have proven to be prolific baby makers, and I should say Jackie Bear and Anna Claire Curran have proven to be very prolific baby makers. Mike welcomed his twins. I can't believe it's been over a month now, Aiden and Ava. And we got some great news right around Thanksgiving that Claire is expecting him. And of course, we did a gender reveal right on Christmas Day, and it's going to be another baby girl. So we'll have 2 boys and 2 girls, 4 kids, 5 and under. So hence why I need to lean into some of the individuals within my office to help keep those promises. Michael and I are awfully busy wrangling babies when we're not putting together retirement plans for people. Y'all, thank you so much for putting a little trust in us. Let me look at the chat, see if there's anything. Great webinar. We'll see. We'll send you the recording. Okay. Shorter show, half hour. Okay. Did I go too long? I'm sorry. I don't have a script for these things. All right. We're going to be sending, looks like it froze for some people. This happens. We're going to be sending, yes, I got sound now. Somerville, hello, hello, hello. I don't see any pointed questions per se. Thank you. Thank you. All right. Very good. Hey, y'all. Go Birds. Thank you. I'll end with that too. Go Birds. Thank y'all so much for putting a little trust in us. If anything piqued your interest during this presentation, I think there's a private chat. If you don't want your name out there saying, hey, I'm interested in the qualified healthcare rider thing, or I'm interested in interest rates going up, just private chat that. Or if you're okay with your name being out there, just say, hey, I'm interested. Have Colin reach out to me. Have Denai reach out to me. Have Gray, whoever you want to reach out, by all means. Thank you guys so much for all the kind words. Just copy the slides. Absolutely, Don. We'll share those with you. All right, y'all, I'm going to get going. Thank you so much, and Happy New Year, and lean into our office. This is when we earn our keep, when the markets are choppy, when the economy is ugly. Now more than ever, come talk to us. Let us go over your plan. Let us make thoughtful adjustments. Let us deliver some peace of mind. Your portfolio was built for this. It was built for uncertain times. Many of you, had we looked at your portfolio at the end of 2021, some of those S&P 500 analysts would say, you're too conservative. You're positioned too conservatively. Now that the market's dropped 20%, NASDAQ's down 30%, you should be taking a victory lap saying, it's a good thing I made those tough business decisions to be a little bit more cautious with my investments. So lean into our office. Let's go over your plan together. Thank you all so much.